Well, this is an extremely interesting note that has come from JP Morgan, Sanjay Mookim, the head of India Research and the India Equity Strategist. Now, what he is saying is that consensus as far as Indian equity is concerned is extremely bullish, and they are mainly focusing on the trends and the positive change that is being seen as far as the economic activity and liquidity is concerned. However, what they are saying is that output gap as well as valuations are something that could be a bit of a dampener going forward. However, what they are saying is that the Indian economy, even though it does not appear strong enough to drive upgrades on an already lofty earnings forecast, they believe that the Nifty at this point of time could cross 15,000 by December 2021. And they believe that the key reason for this is the fact that Indian equities are being dragged up by the global tide of liquidity. Now, what they are saying is that, and what they are advising investors, they are saying market breadth going forward could narrow. They believe investors should de-risk portfolios progressively, and at this point of time, their preferred sectors are banks, information technology, staples. They remain underweight as far as pharma is concerned, and also what they're saying is that discretionary is something that they are quite, at this point of time, being quite uncertain and quite cautious on. They believe that liquidity has proven to be the ultimate vaccine, and they believe that the uncertainty of the US elections are now over. Vaccine approvals are imminent, and central banks are executing the QE squared, or what they're saying is that a significant amount of progressive QE is something that is actually helping global equities go forward and go higher. What they're saying is that most of the risk at this point of time centered around the growth forecast. While the Indian economy has recovered quite rapidly, they believe consumer confidence and income at this point of time remain quite poor. Monetary policy is already quite accommodative, and at this point of time it appears unlikely that a large fiscal impulse is something that could come ahead. Also, what they are saying is that as far as bottom-up themes are concerned, they believe that is something that could give quite a bit of a rally or quite a bit of a legroom of further upside. They believe bottom-up themes in a top-down market is something that is we should look at. They believe real estate, given the fact that lower home prices, lower mortgage rates, as well as higher saving intentions mean that the current nascent uptick in home sales can actually continue going forward. They believe that developers as well as associated businesses, that is the real estate developing pack as well as cement, mortgage lenders, home appliances is something could see a bit of an uptick. They also like interest rate sensitive, so financials over discretionaries is what they are telling their clients. And also what they are saying is that they prefer large private financial banks, IT and staples incrementally. Now what they are saying is that in terms of Nifty, they believe, as we mentioned before, a 15,000 target by December 21 cannot be ruled out. Their key overweights are HDFC Bank, ICICI, Infosys, Hindustan Unilever, while on the other hand, they also, in terms of a bottom-up theme, they like Sun Pharma as well as Aurobindo.